Moving on, while the central bank remains on a tightening course, our next guest says that fixed income provides desirable cash flows to buffer ongoing volatility in the equity markets. For more, we welcome in Lisa Erickson, U.S. Bank Senior Vice President and Head of Public Markets Group. And thank you for joining us here today. Let's start with the current market environment. We've been talking about Chair Powell speaking in front of Congress in a little bit. We've got some huge economic data on the calendar. Generally, where are you seeing the markets right now?
We're modestly cautious really on the U.S. equity market. And the reason why is when we look at the landscape, there are just some ongoing headwinds facing really what's going on with stocks. The first and foremost, as you mentioned, is the fact that we've just got tough inflation. And because of that, the Fed is remaining committed to keeping that monetary environment tougher and to continue to raise rates until it's more clear that, quote, its job is done. So with that kind of backdrop, that really just makes it more difficult, not only for stocks to compete because rates are higher on fixed income, but also simply because that just makes a more difficult environment both for consumers and companies really to continue to spend and earn the way they have. So we do have that modestly cautious outlook. And because of that, really what we are emphasizing are assets that have higher cash flows. As you mentioned, fixed income is one area. And another area is also within the real assets area, an area that's called listed global infrastructure. Again, these are stocks that typically offer essential services, often can index their prices to inflation, and also offer attractive dividend yields. So another source of cash flow in the portfolio.
I want to talk a little bit more about fixed income and especially as we were just discussing the retail interest in fixed income right now. Is that something that you guys are hearing from your clients? Is that, some people who are investors right now have never experienced this in their adult lives, right? They've seen some younger investors that they've seen yields at these levels. So what's been the reaction?
Certainly yields are much more attractive now, and that is capturing people's interest. If you just look at where flows have gone, certainly overall within the industry, we've seen cash and money market funds, for example, increase. And in addition, if you just go up the notch in terms of out a little bit further in terms of maturity, some of those shorter maturity or duration funds also have very attractive yields and are attracting interest. So we are seeing increased, again, there is an alternative to stocks from clients, and we are suggesting that clients, all other things being equal, again, maintain those strategic allocation to fixed income, again, because of more attractive yields. We are cautious about maybe going out over your ski tips on fixed income only because, again, the Fed has made it clear that its job is not done. And so until there's a little bit more settling in terms of monetary policy, we advocate what would be a neutral stance in fixed income.
All right. Setting aside fixed income for a little bit and talking about stocks, at least the pure stocks plays that people think about. You have a different outlook or a recommendation for clients with a shorter term versus a longer term outlook, the shorter term being a little bit more defensive. Could you just outline what you're telling your clients or recommending?
Sure. So one of the questions is for the portion that is within equities, really, where would you invest your assets? And again, for clients with a shorter term time horizon, given the fact that we've got a more uncertain economic environment and headwinds in terms of monetary policy, we believe the sectors that are of more interest in the near term would be more defensive sectors such as consumer staples, healthcare, and utilities. They're attractive, again, because they tend to have more stable earnings over time, even in economic slowing environments. And again, they have very attractive dividend yields, so you're getting more of that return up front. However, for clients who can look out further for more than a year, we do see some interesting opportunities in more secular growth types of names, such as in information technology, such as communications and consumer discretionary portions of that. And again, what all of these more secular growth types of industries have in common is the fact that they can take advantage of tailwinds for continued demand, such as cloud computing, machine learning, anytime, anywhere connectivity. And so those should continue to bolster their longer term revenues and earnings.
And let's also talk about real assets for just a second, Lisa, because that's also an area you're recommending for investors. So what's the best way for people to invest in real assets? Is it, we're talking about real estate can be one of these areas. So I don't know if you're recommending sort of direct investment or still through an equity lens.
Well, for many clients who perhaps need more liquid investments, what we see as attractive in the real assets area is both what we would call more of a normal allocation to real estate, so listed real estate, whatever you would normally have in your portfolio to maintain that, but also, again, exposure to this other area we mentioned earlier called global infrastructure. And really what that represents are industries that really provide the basis for infrastructure for the U.S. economy, such as midstream energy, utilities, transportation, and communications. And again, what these sectors really have in common is the fact that they tend to be more essential businesses and so have ongoing, again, more stable defensive cash flows, as well as offer very attractive income or yields over time. So again, in an environment where there could be more ongoing choppiness within the stock market, getting that upfront return in terms of a higher yield really is attractive.
Lisa, good to see you. Thanks for joining us this morning. Lisa Erickson, U.S. Bank Senior Vice President. Appreciate it.